In this video, I'll show you how to make money in trading even if you are wrong. Now, first things first, we have to understand what is being wrong. Obviously, it's going to be your stop loss being hit, but we have to understand this. Let's just say I want to trade onto the upside, right? Because we're making higher highs and higher lows. Now, let's just say that I'm taking a position such as so, and our stop loss is going to reside below a certain low, and our take profit is going to reside at a certain high. Let's just even aim for these relative equal highs. I know that the price is going to go there. Problem is, I've been stopped out before that ever happened. And that is exactly the problem that you're trading right now. So if we would have had a wider stop loss, that would also mean that our take profit would have been hit. And I know what you might be saying. Through my entire years, I've never seen a trader trading a negative risk reward ratio. We have to firstly understand something. If you're trading a 1-for-1, then your break-even point is going to be 50%, which also means that your win rate cannot be 80% with a 1-for-1, for example. The reason for that is because your edge can't be 30% above your break-even point. That's just a rule of thumb. And of course, the lower your risk reward is going to be, the bigger your win rate must be. But this is exactly what I'm going to teach you now. Your win rate is going to be this high that even with a negative risk reward ratio, you will still be profitable. And I don't even care what you're saying about that you're profitable with your 1-for-2 that has an 80% win rate. You're not profitable. Otherwise, you would have already gotten a payout from prop firms. In this little bit of price action, you can see that currently we're having established movement. Now, what is established movement? It's when you have 2, 3, 4, it can sometimes even just be one candle, such as so, that has strong movement into one direction. Now in this case, it's going to be a type 2 established movement. Already made an entire video on that one, check it out if you want. And judging that we are currently on the daily time frame, most likely we're going to go for the previous day low and not for the high. The reason for that is simply because the movement is lower. But what else is there? There's liquidity above residing. Why is that liquidity? Because you have one swing high and another swing high. Now, both of these swing highs have a lot of liquidity above them. If you would have taken this entire price action and just had one swing high, then of course there is going to be liquidity above that, because essentially every single swing high and swing low that you're seeing on the chart has liquidity. But if price was not able to take out the original swing high, then even more retail traders are going to assume, oh well, this must be resistance, I'm going to put my stop loss right above these highs, right? And a lot of the times this will actually work, right? Price is not always just going to go for your liquidity. So most SMC traders, what would they do? They just want to trade onto the upside with their minimal stop loss, 1-for-10, whatever it's going to be, and they're just going to get stopped out. The reason for that is because in order for the market to go in one direction, it has to take out liquidity. So let's just say the move for the entire market is going lower. If the price just constantly does that pattern where it's making lower lows and lower highs, it means that the market becomes inefficient because it has to grab liquidity of these highs, and from there on it can continue lower. Sometimes it's going to take out liquidity one more time until it's actually showing the move. And this is basically what has happened in here. Yes, we have liquidity in here and we want to trade higher basically, but we need to take out fuel from the market. Have we taken out fuel? Yes, we have. And I want you to pay attention to these wicks. They are telling you a story, so pay attention. It is not just randomly that from this point on price is going to reverse higher. Why? Because you can see we've taken out liquidity and this entire wick is showing you that price went lower. So at one point in time, this entire candle was literally looking something like this, an extremely bearish candle, and you thought that we're just going to go to the bottom of the ocean. Never happened, of course, because price was not able to stay there. So from here on, the next logical level is going to be this high, but you also don't want to trade it just off that because you're going to be stopped out. Once again, the regular SMC trader is just going to take it as that stop loss below this candle low and then take profit all the way higher. The next thing you know, you've been stopped out. Now, with a negative risk to reward ratio, even that is going to work out. If your stop loss is simply just wide enough, eventually your take profit is going to get hit. But we don't even have to be this off with the timing. We can refine it better. So as you can see, now we have the opposite of what has happened in here. Pay attention to these three candles and pay attention to these three candles. It's basically the same scenario, but just in a bullish movement. Now, the market is showing you its hands because it is having established moon onto the upside. If you're going to go in lower time frames, this is going to look like something like that. So basically an uptrend. So what else do we have? The previous day high, previous day low. Are we going for the previous day high or are we going for the previous day low? Now think about it this way. For the market to do a 180 on you and basically not take out the previous day high, how would the candle be looking like? It would have to do a complete 180 on you and then trade lower. What's the likelihood of that going to happen if you're going to look at every single candlestick that happens before that? So just look at this candlestick, for example. We've traded higher. What's the likelihood of the next candle, so this one, doing it 180 and going for the previous day low? Very unlikely. Has not happened. It's also not going to happen in a year. But there is way more to it. We have this FEG. A lot of you guys You like to trade into the FEGs and then away from them and into previous liquidity. That can work. I also do that, but most of the times it doesn't. So what we want to do is understand these FEGs as liquidity points. The price wants to trade back into imbalances to rebalance them and not trade away from them. So let's quickly rewind. We have taken out liquidity. We have liquidity to the opposite direction. So this was our fuel. This is our goal. What else do we have? We have an imbalance, so even more liquidity to trade higher. We have the very current movement onto the upside. I mean, what else is there that you can ask in a trade? Now, I usually like to go for a 10 pip take profit and a 50 pip stop loss. Now, this is going to work most of the times, but you can even refine it more by going into the lower time frames. That's what I'm going to show you now. So here's going to be a trade example for you. And we just want to understand what is currently the market doing. Now, in an uptrend, we're making higher highs, higher lows, and a downtrend, lower lows, lower highs. But that is not really the case in this little bit of price action. Why? Because we're just in a consolidating phase, right? Anything that happens before that, so anything right in here, does not really matter. Yes, we have traded upwards. We only care about the recent price action. Remember, everything I'm showing you right now is on a daily time frame. So we are already looking months into price action, and we are day traders and not position traders. We don't care what happened months ago. So let's look even closer. So zoom in even further and understand what has happened recently. We are still consolidating, right? So in this entire consolidating range, we're having an internal consolidation. Now, why am I explaining this to you? Because I really want you to focus on this little bit of price action. Everything that happens before that is just nonsense. Now, what has this entire candle done? Why am I referring to this candle? Because it's the previous day high and previous day low. It has traded into liquidity. So that is the very first thing that I really care about. We have taken liquidity. Now's the time to go to the opposite direction. Because once again, price moves into one direction, takes out liquidity, and then from there on, it shows the real move. Now, but we also have an entire FEG in here, which also means that this entire imbalance has already been filled. If we would have had some kind of FEG in here, this will be a very good likelihood that we're going to trade higher. We don't really have that, but is that going to discourage us from taking a trade or not? Probably no, because if we're going to look closer onto the 4-hour time frame, all of this are going to be relative equal highs. Though don't get me wrong, this high does not contribute to these relative equal highs because the movement is just quite far away, as you can see. But everything that happens below this certain high, so these highs, and also these highs, they still belong to the same move basically, because that entire thing is the same price action lag. So the next logical thing is when we have liquidity being taken, so that's going to be our fuel, and we have liquidity higher, where is the market more likely to go? Of course, to the upside. Now, but we also have the previous day high, which are also going to be relative equal highs if we're going to drop down onto the 1-hour time frame. And from here, I really want you to pay attention. There's also information for you to take away. First things first, we have traded into this FEG. Now, this is not just something that randomly happens, but it's giving you confirmation that the order flow is bullish right now. Let's just say you have a scenario like so. You're just trading higher and there's no FEG lower, right? Price does not create FEGs. We're just trading higher and higher. Very small pullbacks. That means that the price is eventually just going to snap and immediately just going to go on to the opposite direction because the market is just becoming inefficient, right? So eventually these inefficiencies are going to be taken out. Now, in this little bit of price action, what we have currently going on, that's not the case. The market keeps being efficient because it trades into the FEGs. What has happened in here, we have traded into this FEG. It's also what is about to happen here. We have an FEG, probably going to trade into it and then from there higher. Now, from this point on, I want you to go to UTC standard time. That's going to be your time zone that you want to trade in. And then you want to go to 23 a.m. The reason for that is because the next candle is going to be the 0 a.m. open. From that point on, you're just going to take a position. Most of the times, your take profit is going to reach to the previous day high. But out of experience in a lot of different backtesting sessions, which I'll show you in the end of the video, I know that a 10 pip take profit is quite usually fine. For the stop loss, you can aim for 50 pips or something that is close to it. In that case, the stop loss is going to reside right below these lows. Why is that? Because this is basically our liquidity rate. Simple as that. Now, from here on, we want to take the position. Since we already know, though, that we're going to trade into this little bit of an FEG, we're just going to put our entire entry a little bit lower. Now, these little adjustments are going to go a very long way. From that point on, you're simply just going to take the position and watch how the trade is going to play out as I take profit. But I'm also going to show you an example where you're going to get into a deep drawdown and how you're going to manage that. But before that, I want to show you something very interesting. So the entire promise of this video is how to make money even if you're wrong. So we have identified that this entire day is going to go onto the upside. So we're bullish for the buys. However, if we're going to skip the entire day, let's see where this is going to land. As you can see, this entire candle was not so bullish, was it? Now our take profit, if we're going to go into the 4-hour time frame, has already hit. But the daily candle is just looking indecisive. So we were not really right, but we're also not wrong. But most importantly, we made money on that trade. That's all that matters in trading. So which also means that this entire day could be looking the opposite way. So it went lower first and only then higher. So that also means this entire day that we traded could also look the opposite. So let's quickly compare. We have traded higher into our take profit, then lower. But it could also look the opposite. We traded lower and only then to our take profit. This is only going to work if your stop loss is going to be wide enough. Now here's an example where it's not so obvious. So in here, I really just want to observe the charts. We're not even predicting something. Let's just see what the price action is going to do. So first of all, we're just trading lower. We have taken out that low. So what's now the most logical thing to do? Are we trading onto the upside or to the downside? Now pay attention what has happened in this entire price action. A lot of you guys will be saying now is the time to actually go onto the upside, because then we have relative equal highs, liquidity, and the entire story just repeats. And you're not even wrong on that. However, it is not going to happen right now. Pay attention to this little bit of price action. This entire candle has displaced below this candle low, which means there's a lot of momentum backed off by this entire candle, which means we're just going to continue lower or some kind of previous liquidity that has happened. So the problem that we're creating here is not knowing where the price is going to go, but we just don't know when that is going to happen unless you're paying attention to the body closures of the wick. So let's observe what is going to happen next. We need movement onto the upside. This entire candle has still not closed. Now it closed. And we have even gone for way more liquidity than we initially expected. Now let's see what is going to happen once price is going to take out this liquidity point. And by the way, all of these days could have been traded because this is on a daily chart right now. But for right now, really just focus on the liquidity points. So liquidity point number 1 has failed us, body closure below it. Liquidity point number 1, body closure has failed us. Liquidity point number 3, same story. Body closure below has not shown any signs of reversing. So let's further observe this, and we need some kind of movement that is showing us, okay, now it's enough liquidity taken. Now we're going to go for the opposite side, because remember, all of this happening right now is just fuel to now go for this liquidity point. So we still need some kind of confirmation that is going to identify that. Now previously, in the very beginning of the video, what have I shown you? This is established movement. So now the price is clearly telling you it's enough for me. I actually want to go to the upside, and I've taken enough fuel that I can sustain the move onto the upside. We want to ask ourselves, are we going for the previous day high or are we going for the previous day low? If the answer is I don't know, then you don't even want to trade that day. Now in this example, we know that most likely we're going to go higher, not lower. What else is there on the daily chart alone? We have this FEG, and you see how we're just going to refine the entire entry by doing the exact same process. Now we're going to drop down onto the 4-hour time frame and see if the entire price action is actually efficient. And now pay attention onto the 4-hour time frame. We have traded into that FEG, so that is now becoming our movement onto the upside, basically our order flow. We have another FEG which has also traded in here. It's a very small one, but we have definitely traded into it. So this is once again indicating our entire movement onto the upside. Since we know that we want to trade into the previous day high and not for the previous day low, we're simply just going to take a trade off of this one. Now we drop down onto the 1-hour time frame, go to 23 a.m. because the next candle is going to be 0 a.m. and from here we're just going to take a trade. As I've previously told you, your take profit is going to remain at 10 pips. However, a lot of the times you are going to be able to refine it. In that case, do you see this entire candle? And I want you to really pay attention about this one. I've actually never seen somebody teaching this simple concept on YouTube. Pay attention to this wick. Is there something that this candle is missing apart from any other candle that you're seeing on the time frame? Pause the video if you need time. But basically it has no wick onto the upside. Rarely ever that happens, that a wick has no candle onto the up or downside. And even in the cases where it's going to happen, it is quickly going to get revisited as a liquidity rate. So this is basically going to be your take profit. Potentially you could even base it off to the previous day high, although I just don't recommend that most of the times. Your stop loss is going to reside right at 50 pips. And you're going to enter the trade at the candle low. Why? Because if you're going to go lower onto the 5-minute, this is also going to be a very small downtrend. So it's the same logic that we apply onto the daily chart. Are we going for the previous candle high or for the previous candle low? Probably for the low. So we're going to base our entire entry. From here, we're just going to take a trade and let the trade play out. Not a take profit hit. Once again, it is not going to look as smooth as this one. Sometimes you're also going to get into a drawdown, and that's very normal because this is what I'm telling you about. What would have happened if we're going to put our entire entry right at the previous day high? It would have still been a take profit. But if we're going to go onto the daily time frame, it is not looking so smooth. Because remember, we wanted that entire candle to go into the previous day high, which has not happened. Only the next candle went higher. So you see, we're not right on the entire day, yet our take profit has still been hit because the entire stop loss was simply just wide enough for us to endure. So from here, you always want to skip a couple of candles until you see the same price action occurring once again. Now pay attention. Yes, we have liquidity higher, but if the price is clearly showing you that it's going in one direction, then you don't really care what is higher. You only care about this liquidity if the price is actually going there, such as in this little bit of price action. This is why I'm always telling you, pay attention to what has recently happened. We have our established movement onto the downside. It doesn't have to be 3 candles. It can sometimes even just be 1 candle that shows strong intent to go in one direction. So are we going for the previous day low or for the previous day high? Of course, guys, probably for the low. So now we're going to drop down onto the 4-hour time frame. You probably already get the idea. Probably we're trading lower because we also have relative lows right in here. If we're going to go onto the 1-hour time frame, these are all just small different lows where the regular retail trader is going to think, okay, from here we're just going to trade onto the upside because we have reject offered 1 time, 2nd time, 3rd time, 4th time. We might as well just do it a 5th time and then trade higher. But the reality couldn't be farther from the truth. So we're going to go to 0 AM UTC standard time. Stop loss is going to reside at 50 pips or something that is very close onto it. Pay attention, this entire candle has no wick onto the upside, but since the entire bias is going to be bearish, this doesn't matter anymore compared to the previous example that I've shown you. So our entire take profit is going to remain at 10 pips, and from here you really just want to take a trade. Now this is not just BS that I'm showing you, this has been backtested for years of data. And it's all been collected in my mentorship with a full journal for you to access. The results that this strategy gives everybody who is using it, whether it's a student or just somebody who casually watches the videos on YouTube, are just stunning. I mean, just look at all of the profits you're seeing on the screen right now. It just doesn't seem to stop. The reason for that is because everybody who's using it goes on extensive winning streaks. In this entire video, we had an example where we went a little bit more into a drawdown, but we didn't really have that deep drawdown trade. This is why I recommend to you watching this video. It's going to explain to you everything from A to Z on how to do this on a day-to-day basis. It's the full masterclass. There's nothing for you to lose. It's all for free. Now, to not miss out on future videos, make sure to subscribe to the channel, but also turn on the notification bell so you're not going to miss out on these videos. Thank you guys for watching and see you in the next one.